morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
All right, welcome back to Insurance Matchmaking. If you listened to the show last week, I talked about a lot of the short-term cares that help bridge the gaps to long-term care, or maybe you've been turned down for long-term care because of some health reasons. Some of these plans, you can still get approved for them. So check with one of our professional agents at Matt Libby Insurance, and we'll match you with a plan that will help protect you against a lot of those out-of-pocket costs. But today I'm going to title is, traditional versus hybrid long-term care, which one actually makes sense. And it's kind of funny, as I talked about last week, I've been using ChatGPT to kind of help me get my shows prepared. And I've been using, if you've checked into my pre-recorded shows, you can go to insurancematchmaking.com, or you can go to YouTube and search Insurance Matchmaking. That's my handle on YouTube. All of my past shows, and I say all, we may have missed one or two here and there, but my past shows are all recorded on YouTube. And so you can play those back. You can speed it up and listen to me talk really fast, like the guy that gets the disclaimer at the end of the radio program. So anyway, you don't have to spend a whole half hour listening to me. You can speed it up a little bit. So those shows are, like I said, they're recorded and then put out on there. But I've been using ChatGPT already to summarize those shows, so to come up for the summary, and sometimes a title for the show. Sometimes I don't title them. But I thought it was kind of funny because as I asked ChatGPT to kind of give me some ideas and some talking points to talk about the short-term care and the long-term care. So, so like I said, we're going to be digging into a big decision: traditional long-term care insurance or hybrid life insurance and annuity plans. And I'll tell you right up front, I've got a strong opinion on this one. That was a direct quote from ChatGPT, putting words in my mouth, because some of my past shows, you can tell I have a strong opinion of this. I'll straight out say it. I'm not a big fan of traditional long-term care. One, it's very expensive. Now, I will say, if you're able to get it through your employer, through a payroll deduction plan, like they do with Aflac and some of the other, disabilities and cancer plans that you can get at work. I tell everybody, get those plans. I can't compete with those prices. I want you to be able to afford what you're getting, but I still want you to come to me for other things. Maybe I can come up with a better life insurance plan for you, or maybe I have a cancer plan that does things a little different than the one you can get through work, that maybe you might like my plan better. So, again, a lot of times people don't have any of these things from their employer. By all means, come see us and see if we can help you. But the hybrid we've talked about, and I haven't talked out much on the show here, I don't think. I haven't focused a lot on life insurance, but I do offer life insurance. So, if you want somebody to look at some life insurance options, please get with me. We can figure something out there. But a lot of the plans, we talk about the new plans. Do you have the old kind of life insurance or the new kind? And people kind of, what? Do you have one that pays out and you don't have to die? Because that's what people usually say. It's not life insurance, it's death insurance. But there are plans that you can access that death benefit for chronic or terminal, chronic illness, chronic care, chronic or terminal illness, and you can draw that money out early. And then there's also ones that have what we call a long-term care rider. You can have that on a term plan. I would recommend, that's a good option with a term plan, but I would recommend you do it with a permanent life plan, like whole life, or a index universal life plan. And the biggest kicker on, and again, like I said, my biggest thing, and I'm going to go ahead and quote ChatGPT's script here. You pay premiums every year. You need the care, it pays. If you never use it, you lose it. That's my biggest issue. That's why I'm not a big fan of traditional long-term care. It can be very expensive, and again, if you wait until you're 60 to get it, it's going to be even more expensive. And the premiums can go up as you get older. So they're not something you lock that premium in. That's where I like the life and annuity hybrids to fill that gap for you. Because one of the big things on that is, one, yes, it's going to combine that long-term care benefit with that life plan. And if you need the care, it pays. If you don't need the care and you pass away and never use the long-term care benefits, you have a death benefit that will pay to your beneficiaries. And again, I say beneficiaries, doesn't have to be your heirs per se. Maybe you don't have any heirs, but this is a good way to protect your income. And a lot of people have charities, nonprofits that they care, very much about. It could be your church, it could be, animal rescue, and you would rather leave money behind to that charity you care about versus it just going to the insurance company. So that's the thing. Long-term care, this may be kind of a morbid thing, but they kind of hope you die without using your benefits because they've invested the money you paid over all the years for in that's how they earn their profit. So if they don't have to pay out the claims, then they earn more profit. Now they will pay the claims. If you're entitled to the claim, they're going to pay it. But if they don't have to pay it, they like that. Whereas if it's a life insurance policy, they know it's going to pay out eventually. And then annuities are the same thing. And one of the things that I want to speak on this, again, I've talked about qualified funds. One of the things I talked about last week was you don't want to have to draw out of your retirement funds or draw out of your savings, your investments to pay for that short-term care. Well, because one of the big deals there is if you draw that money out of your qualified funds, then it's taxable income, and that so you raise your taxes for that year, and it also could push you over that threshold, depending on where your income is, could push you over that threshold where you're paying more for your Medicare now because you have that IRMA surcharge. So the beauty of is when you take money out of, say, your annuity or your life insurance plan, that for long-term care, that's not taxed. That's not considered income. It's paying for the health care. So you've got that structure in the money's there. Now you're taking it out for long-term care. It's coming out tax-free versus just cashing money out of your retirement to pay for your expenses. You did that as a taxable transaction. So that's one of the big reasons to go with one of these kind of hybrid plans. And the reason I say it, and they can be a qualified fund. That's what we did with my wife's 401k. When she retired from her job a couple years ago, we went ahead and got a hybrid annuity plan for long-term care. So, and I was listening to somebody on a YouTube this weekend, and it kind of, the way he addressed it, I hadn't looked at it that way, was it's a long-term care plan that works like an annuity. Instead of looking at it as, hey, there's an annuity, here's an investment vehicle, as some people will look at it in that way, is you're funding long-term care, but you're using an asset to do it. And when you draw the money, you draw money out, it's on claim, just like you would with the short-term care plans that we talked about last week. You have that, the doctor says you can't perform 2 of the 6 activities of daily living. It's all it takes. It only takes 2 of the 6. You don't have to be completely bedridden. It's just you can't do a couple. And the other trigger for that is, and what probably is, I don't know, it's probably a majority of the people who do go on claim, is it's memory care. And one of those things that is just kind of, I look back on, and I know a lot of people, and I'm going to go down a rabbit hole here, but if you know me, and you've heard me, I'm 67 years old as the day I'm recording this, so if you're listening to this a couple years from now, add to that. But it seems like everywhere I turn, 1 out of 5 people I know has a child that's autistic, and some of them, I know somebody has 3 children, and all 3 of them are autistic. I don't remember that happening when I was a kid. I think I went to school with one kid that I think might have been autistic, that I went to elementary school, and another young man that I went to high school with. He probably, I think what they call it, Asperger's. It just seems to kind of fit that it would have been that way. Now, I'm sure there were probably some of the kids that were like that were considered mentally retarded, but that seems to happen a lot more now. But the other thing is I feel like we're seeing more people dealing with Alzheimer's, and I think some of it that has to do with we've made improvements in healthcare. People are living longer. Something that might have killed somebody when they were 60 was they caught it, they fixed it, but now they're 75, they've lost their memory because they're still alive, and that wouldn't have happened in the past. They wouldn't, because they would have already passed away. Maybe they had died from that stroke or that heart attack before they had memory issues. I think there's just more memory care going on now, and some of it too maybe could be early diagnosis, but I think a lot of that is just people are living longer than they did, 40 years ago, 50 years ago, and so we're having more people who are needing that long-term care because of memory issues. And that's an instant trigger on these plans. Now, I say instant trigger, again, if you have it set up for a waiting period of 60, 90, 180 days before it kicks in, because you still feel that you'll be able to afford that and you want those benefits to cover, longer, because they are finite. They're going to be 3 or 5 years of coverage. Some of them you can have a long-term care continuation of benefits. That's a little extra premium you might pay on those. So those will come up to continue that care. So that's something to think about, that, when do you want to start drawing the benefits? But as I said, the memory issue can be, and it just takes the diagnosis. You can still be your memory may not be terrible. You're still able to live at home. You may be still able to live at home by yourself, but you need a little bit of assistance. It still is that trigger. You can get that claim and have that. And again, who wants to move into a nursing home if they don't have to? I don't want to live in a nursing home, but I think I probably will be in assisted living sooner than others. My wife and I have both kind of discussed that and I'm actually kind of looking into, maybe in the next few years. I mean, I don't know how many years it's going to be, but moving into, what they call the luxury retirement resort style living. It costs a lot of money, but, it's one of the reasons I'm doing this business. I want to be able to afford that. But I don't want, I still mow my lawn. Did it last Saturday. And just a riding lawnmower, didn't do weed eater trim or anything. I was worn out by the time I was done. So probably not a couple more years where I'm still doing it myself, and then I'm going to start paying somebody. So I can kind of take that money that I'd be paying somebody to mow the lawn, and that money's going towards I'm living in a place where I don't have those maintenance costs. So I'm thinking that's going to be something that we do. I've looked into the thing, after going on a cruise, and I said, before COVID, that used to be a really viable option, was to live on a cruise ship. I mean, I don't know that it was viable for us, but for a lot of people, especially, maybe they don't have grandkids, or they don't see their grandkids all that often anyway. It's like saying, when grandma moves into the nursing home, people, everybody stops visiting. So the thing is, so if you're on a cruise, you've got, medical facilities there. You have maid service. You go to the cafeteria to eat. Everything you need, you've got there, and you can travel the world. And they basically, and if you move from one ship to another to continue your cruise, but going a different route, you pack up your bags and they move the bags over to the other ship for you. You could plan a vacation, and pay for the kids and grandkids to come spend the week with you on a cruise, and that's what they would have seen you because they live across country anyway. So there's some of those things that can be perks, and you could do that way. So anyway, we're on up to the break here, and we'll be right back, talk some more about these hybrid plans.
Life moves fast, even here in the Upper Cumberland. Is your internet and wireless keeping up? More families are bundling Twin Lakes Fiber Internet with Tri-Lite Mobile for faster speeds and dependable coverage. Right now, get your first Tri-Lite Mobile line free for an entire year. No gimmicks, just real savings. Enjoy lightning fast internet at home and reliable wireless everywhere you go, all backed by your local Twin Lakes team. Visit twinlakes.net to bundle and save today. Tri-Lite Mobile, better wireless from people who bring you better internet. First line free offer requires Twin Lakes internet service. Other terms apply. See twinlakes.net.
Join Habitat Restore at their pop-up donation event every second Saturday of each month at First National Bank in Sparta. The Habitat team will be there ready to go to receive your donations. So don't miss an opportunity to declutter and make a difference at First National Bank in Sparta with the Habitat Restore pop-up donation event every second Saturday of the month.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, and we're back. I know I'm I've done this the last couple of weeks. I seem to be running a little long on my first segment. I think I've got plenty of time, and then I look up, I better wrap up for the commercials here. But just talking about, like I said, we compare those hybrids, and I didn't get as much into it as I meant to. Because like I said, with my wife, with our plan, she was able to roll over her 401k into this annuity. So she wasn't taxed anything on that plan, and we had the money to go ahead and purchase this annuity to cover our long-term care. But it's still, and again, we can draw it out anytime we want to. It's going to reduce our long-term care benefits, and if we just start drawing out of it, and I say drawing out of, to draw out of an annuity, these type of annuities, you actually annuitize them. You start drawing a monthly amount in that until it would run out or whatever. So we don't want to do that on that plan because that's the one that's going to be, that one's in reserve for long-term care. But we were able to roll over, and you don't have to be retiring to do that either. You do have, with annuities, you have in-service distribution. As long as you're at that age, that 59 and a half, that you could start drawing your 401k without any tax penalties, you can roll that over into annuity. And it doesn't stop. If you're still working, you're not liquidizing your 401k. You're just doing an in-service distribution. So say you have $250,000 in your employer's annuity. You could take $150,000 of that, roll that into in your 401k. You can roll that $150,000 into your annuity. Now you've funded your long-term care, and you're still contributing to your 401k at work. And then when you get ready to retire, then you decide what you're going to do with that. Now, one of the big things I've talked on, I didn't talk about it as much in this segment or in this episode, but one of the beauties of an annuity is it can grow in value. It can tax deferred because it's qualified funds, just like your 401k, but it's not captive to the volatility of the stock market. You have a floor. If the stock market drops 25%, you don't lose anything because you hit that floor of 0%. But say that has a 25% gain, well, you may only get, say, 10 or 12% because that's your cap, but you're never going to lose your investment. And so you don't want to be that aggressive with your income when you're at retirement age because you may not have time to recover. I know we went through some periods, when we were both, I'm still working, but when my wife was working and contributing to her 401k, that, we had those years like 2008 and then again 2013, which really kind of hit hard because just recently where there was a big downturn in the market and we'd gained that back of like in 2020. Things, 21, things went down and they perked back up, and we at least fortunately had a little bit of gain on her 401k before we rolled it over. But if we'd have rolled it when she first retired, maybe it was 23, we would have had more to roll over. So that's why I'm saying, hey, if your plan is doing really well, this is a good time to maybe take. You don't have to cash it all out. And of course, if you're still working, I encourage you to continue contributing because your employer is also matching. But you can do that in-service distribution, and it won't affect how your employer is contributing to your plan, and it's still growing. And then your money would be growing in an annuity without the risk of those down markets like you do with your mutual funds. So that's something, again, got questions on that, give us a call. We can go over that. I'm not an expert on annuities, but I know enough to be dangerous, as they say. But I also have, people that I can put you in contact with, especially, if you're, you have a lot larger nest egg, 250 to 500,000 or more to invest. I wouldn't try to handle that myself. I would put you with somebody, and like I said, I have partners that can help you with that, what to do with that money without handling it better than I would. Say you got $50,000 that in a CD that's maturing. We have what they call the MIGAs, the multi-year guaranteed annuities. They'll pay out a little bit higher rate than those CDs. Now you have to leave it in there maybe a little longer to get that same rate, but you can definitely beat some of those rates, and that's something that can help you with real easy. Those are real easy to apply for, and it's just a matter of moving it from one account to the other. So give us a call on that. Like I said, annuities can be a great asset on that. But the hybrid annuities, but we do that with, the life insurance. Again, it's kind of the example. Same thing is kind of with annuities, same thing. The life insurance hybrid, you put in $100,000 and you could have $300,000 in long-term care benefits. And great, like I mentioned, if you're using that gain for long-term care, you're not taxed on it. So that could be $200,000 of long-term care that doesn't come out of your retirement funds. That's the big thing we're going, we want to encourage everyone not to self-insure. I mean, that's the whole purpose of insurance is to pass that risk, that expense risk, onto someone else. And if you can do that with the insurance company, we don't want you to outlive your money. We want you to have a nice long life. I'm hoping to have a long life, but I don't want to outlive my money either. And then what money's left, I got grandkids. We want to leave something for them. Our kids, our grandkids, to have, for them to be able to continue, or maybe even improve their financial position. Let us help you protect your legacy, as they say. The thing is, the beauty is that, again, if you never use it, you still have that money to pass on to your beneficiaries. So traditional long-term care might have a lower initial cost because you're just paying that monthly premium, but you do have those premium increases. You can also have again, is the use it or lose it. Now, with a hybrid life long-term care, you're going to have guaranteed premiums. The premium's not going to go up. You're basically, on that one, you're paying for life insurance, but you can use that life insurance for your long-term care costs. So that's the beauty there. And I mentioned earlier too about some of the term life plans that have the living benefits. The way they're done. In fact, I just wrote one for a young lady this last week. It's an Index Universal Life, and it does have I think it's terminal and chronic care rider early distribution. It takes 80%. I think it was 75 or 80% that you could draw out earlier of the death benefit. And then the portion that's left over is still there as a death benefit for final expense. So she wanted to make sure that she's protecting her children as they get older, that they would have, if they need, they pay for the house, provide them some income because she's no longer able to work. And so it fits both of those. It's, if she becomes disabled, she can draw on that and she still has the money on that. Or if she does pass away, the entire amount passes on to her beneficiary. So that's a great one there. And again, the same thing with the hybrid annuity. You can reposition your savings. It's fairly liquid. And that's the thing. It's fairly liquid. You can start drawing some out of the annuity, and still have the long-term care benefits, even though you're starting drawing some of the money out. So you're not wasting your premium. It's your money. You've just put it into a different, as sometimes they call, vehicle. It's there to help cover your needs, your health care cost. So, and we talk, and then short-term care can fit in here. And if you remember those, the plans from the last episode, we talked about Aetna, Manhattan Life, GTL, Heartland, Bankers, Fidelity, and these, it's like they fit in the entry-level protection. Sometimes with long-term care, you may have a 6-month waiting period before you could even use the benefits. The short-term plan can fit in there, fill those gaps. They're not a replacement because they are short-term care. They're going to be good for 1 to 2 years. Can be you can stretch out a little bit longer if you're not using all your benefits. If you're only using like 2 to 3 days a week for like home health aid, then the coverage can last you a little bit longer there. So we're saying, we don't want you just buy insurance. We want to build a strategy. And that's why, and we can combine these. We may do the rollover for the long-term care and still put in some of those short-term care plans to kind of bridge that gap. Because again, you'll have more long-term care if you have a longer elimination period, even with the hybrid plans. So we are talking retirement planning. I'm not an investment planner, but I can help you plan your retirement. That's what I'm specializing in, and maybe I'm going to get a little bit more into, that retirement planning versus just, your Medicare. One of the things I really feel guilty, and I'm going to reach back out to a lot of my existing clients, is I've got all these different short-term plans, short-term care, and I've been looking. It's like, and I didn't do a good job of presenting those things. I just, hey, here, let me see on the up. Oh, you want an Advantage plan? Okay, here's the one your doctor take. All your meds are covered. All right, thanks. We'll look at this again next year. And that's all I did. And I'm getting paid well for that. But one, I could have been doing a little bit more, have a little more income, but also taking better care of my clients and making sure we cover some of those gaps that Medicare doesn't cover. And so I'm taking this approach to, I guess, in some way use a more holistic approach of planning your retirement. But again, as I mentioned, I don't know if I mentioned in this show, I know I mentioned last week's show, is you don't have to be approaching, immediately approaching retirement. You don't have to be getting ready for Medicare. You could be, your late 30s, early 40s, and still be a great candidate for some of these plans that I'm talking about. And again, as I always mention, the younger you are when you get these plans, much lower your premiums are. Same thing with the whole life plans. And they build value. They grow in cash value. So if you start at a younger age, it's going to cost you less to do that, and that money has longer to build. So you're investing in yourself. Put some money away. I don't know. I guess I'm thinking back. When I was overseas, I'm always hearing all the public service announcements. It's pay yourself first and all these things, because we didn't have commercials on our Armed Forces radio network. So I'm about out of time here. I did want to get that bit. And like I said, there is no one size fits all. So remember, at Matt Libby Insurance, we can cover from head to toe. It doesn't have to cost you an arm and a leg. And our insurance matchmaking approach is we don't sell you policies. We match you to the policy that fits you. So until next week, remember, continue tuned in to Grace 107.7. Go to insurancematchmaking.com. You can find our past shows. They're all on YouTube. So we try to keep pretty current. We may be a couple weeks behind to getting those, but hopefully the most recent shows are going to be up there. We get them up as soon as I can get that set to my webmaster. They create the YouTube and post it, and they do it very quickly once I get set to them. So I'm usually the hold up on getting those done, not the webmaster, not the radio station, but. We'll talk again next week right here on Grace 107.7 Insurance Matchmaking.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.